Well, we're just about a week away from the elections. The markets seem to be in a corrective mode. Coronavirus outbreaks are picking up. What does all this mean for the market? Well, let's find out. Joining us on the program from Bianco Research is Jim Bianco. Jim, since elections are coming up next week, I want to talk about something you had on your site, and that is the difference between the polls and those that are betting on the outcome of the election. I wonder if we could talk about that for a minute.
Sure. Let me just start off by prefacing that betting on elections is a time-honored tradition in the United States that dates back to the Revolutionary War. During the 19th century, we didn't have polling. We had people betting on the floor of the New York Stock Exchange, and that was the way that local newspapers used to tell their readers who was winning the market. It was only after the Great Depression, George Gallup and the Roper organization started polling. Now, I've been tracking the betting markets and the polls since the late 80s. They typically say the same thing. For instance, 4 years ago, the poll analyzers like the 538's, Nate Silvers, were giving Donald Trump a 15% chance of winning. The betting markets were giving him a 15% chance of winning. They were both equally wrong. Today, the polling analyzers are giving Trump about a 10% chance of winning. The betting markets are at around 41%. Now, he's still under 50 in both. Biden is still the favorite in both, but 41 versus 10 is a huge difference. That could basically show up, if that's correct, in terms of how the Senate comes out. Last thought for you, what do I think accounts for the big difference? The age-old question of, is there a shy bias for Trump or a hidden Trump vote? People that will vote for Trump but just aren't saying it out loud. I think the betting markets think there is, and that's why they've got him significantly higher percentage of winning, although still less than 50. But the pollsters and the poll analyzers assume that doesn't exist, that the polls have got it right, that they've captured it. And if you assume the polls are right and as face value, then yeah, 10% sounds about right.
Well, let's talk about COVID. We're seeing more outbreaks in Europe, a few places here in the U.S. The Wall Street Journal did an article about Southern economies doing much better and recovering much better because they weren't as heavily into lockdowns as, for example, in California, New York, or elsewhere. So let's talk about COVID and what that might mean for the markets.
Yeah, I think that's right. That COVID is the big economic determinant of 2020, and more specifically, whether or not you've gone through a lockdown or you haven't gone through a lockdown as well too. And as far as COVID goes, I know whenever I tweet this out, this always gets a very emotional response. And I've argued the reaction function for the economy is the number of cases. When the number of cases goes up, people tend to stay home, governments tend to act. People go, yeah, but the hospitalizations are down and the death rate's down. Yeah, that's good. That's true. But that's not what drives economic behavior. It's the number of cases. Right before we started talking, President Macron of France has now floated the idea of a complete French lockdown because cases are spiking. Yeah, the death rates aren't up and stuff, and they can't get it under control, and they might go back to full lockdown again, largely because of cases. As far as with that as a backdrop, where are we right now? In Europe, the number of cases is just gone exponential. It is it's 4 or 5 times greater than its peak in April. And that's across Europe. Whether you're talking about Germany, the UK, Spain, Italy, they're all making major new highs. The governments are talking about rolling back on the reopenings or locking down. And in some places, especially in the UK and Italy, the populations are, for lack of a better word, they're rioting. They don't want to go back into lockdown. Pandemic fatigue is a real thing. In the United States, it's coming. We made a new all-time high on a daily case count last week. Some of that's because of increased testing, but a lot of that's because the positive rates are going up, and we tend to have, at least we did in the spring, we tend to lag Europe. Final thought for you. Why is this happening? I'll give you 3 reasons why this is happening. Number 1, it's getting colder outside. We're staying inside. The virus transmits better inside. Number 2, I mentioned, is pandemic fatigue. yeah, it's spiking. We should be wearing masks and social distancing, and we're sick of it, and we just don't want to do it anymore. And so that's contributing to it. Number three, there might be a mutation in the virus. There's lots of stories saying the current version is less lethal, but more contagious. But nevertheless, cases is what drives the economy. If cases go up, governments have to react. And if they have to react, that means rolling back, and that will hurt the economy.
Let's say the cases pick up and more governments go into lockdown, whether it's here in the US, Europe, or elsewhere. Jim, when you reduce the amount of goods that are produced in the economy because of a shutdown, or reduce the amount of services that are provided, but at the same time, you're given money to people to buy these goods and services, it seems to me that this has all the makings of an inflationary outbreak.
I think that that's exactly right. Just to reiterate what you said, on the supply side, the economy right now is smaller than it was a year ago. GDP, gross domestic product, is less than a year ago. We're making less stuff and services than we did a year ago. So whenever you talk about inflation, people go, well, we got excess capacity. Well, we got rid of some of it in terms of the economy. We're just making less things and providing less services as well. On the demand side, we keep handing people money. And I'm not saying that that's wrong, but we handed you a $1,200 check, $600 a week for unemployment. That money is still largely sitting in people's accounts, even though they're not getting it. And we're promising more of the same in terms of talking about whether or not there's going to be more stimulus. Now, if you add into that dynamic of less supply, stimulating demand, that should produce higher prices. Add into that dynamic a vaccine. Let's say that then in the fourth quarter, the first quarter, we get some kind of a credible cure or vaccine. And then we could say, now that I've handed you all this money, now we've produced less stuff and you're bidding on it. Now we're going to throw the economy back open because we found a cure or a vaccine. You could really see prices of stuff go up, otherwise known as inflation.
And I guess maybe carrying this forward as governments, they're talking about a stimulus package, depending on the outcome of the election, that could be anywhere from $2 trillion to maybe $3 trillion plus. We just reported a $3.1 trillion budget deficit, Jim, and that was with half of the year actually with the economy doing well. They're talking about next year we could even see maybe 4 or even 5 trillion as a budget deficit. How long before we see a rebellion in the bond market to rising budget and trade deficits?
Well, to put that number in a different perspective, that's $3 trillion, 3.1 to be exact, is 16%, 16% of GDP. Only 1943 to 1945, when we were selling war bonds to finance the war, did we see a higher budget deficit to GDP in the 200 nearly 50-year history of this country. So, and as far as government spending goes, it accounted for 33% of GDP in the year ending in September, where in typical years it's in the low 20s. And only again, 1943 to 1945 were the only years higher that we've ever seen. So the government is just spending money like crazy. Now, the libertarian in me says, boy, this is bad and this is terrible, and I agree with that. But there's also the takings clause of the Constitution. I want to throw that out there, meaning if the government comes and takes something from you, like your job, like you were going about your business, and then they all of a sudden they said, you have to close your business and you have to tell your workers to stay home, they owe you something for that. And that might be part of what's been going on. When does the bond market rebel against all of this? Comes back to the big I word, inflation. As long as you do massively large government spending and budget deficit programs like we are now, and you do not have inflation, there's no misallocation of resources. There's no perverse outcome. You get inflation, and then you get the perverse outcome. The bond market starts to reject it by people saying, if inflation is coming, and that means the price of everything's going up, I don't want to own a fixed income security in an environment of higher prices. They sell those bonds, yields go up. The only way you stop inflation is you got to stop the spending. And then that really starts to reverse the economy in a big way. So it's really about inflation. When does inflation return? My guess is we're going to see it next year. After we get through the year-over-year changes in the lockdowns, because remember, we were locked down in March, April, and we like to compare inflation versus 1 year ago. But when you get to April, May of 21, and you're comparing it to April, May of 20, post-lockdown, I think you're going to start to see inflation, and the numbers are going to show up around the mid next year.
So, given the attitude of the Fed, they seem to be intimating they're going to be a little bit more lenient on the inflation side. So let's say that, Jim, all this price pressure starts to come about next year as we use up the spare capacity, as we give people money, and we restrict supply. What about the Fed's reaction to this? Do you think they'll sit on the sidelines, or would they be hurt credibility-wise if inflation starts to rise and they do nothing?
In the early stages, the Fed will take credit. In the early stages, the Fed will say, this is what we want. It is a sign that the economy is getting better, and it's all part of the grand plan. If inflation continues to move higher, then they might react. And by the way, let me put a definition of that for you. One of the Fed's favorite measures, for all its warts, is core personal consumption expenditure, or core PCE. If that measure, which is around 1.5% right now, still recovering from the lockdown, was to get to 2.5%, 2.5%, that's all I'm talking about, that would be a 27-year high in that measure of inflation. So when I say, if inflation returns, I'm talking about 2.5%, 2.75%. I'm not talking about 7 or 8 or 10 like we had in 1980. That would be a generational high. If you get to that generational high, then the Fed will say, as you're going there, the Fed will say, it's all good. This is what we planned. But when the bond market rejects it and people start selling bonds, then the Fed will have to change. I've used the analogy that the Fed is like a post in the ground, and the market is a big 1,100-pound horse tied to that post. Well, the market's got no reason to be spooked or upset, so it just stands there tied to the post, to the Fed. It doesn't do anything, which is currently what the bond market is doing. You spook that market, like when you spook that horse, it will rip that post right out of the ground and it will go wherever it wants. So if you get inflation, that bond market will go, and the Fed could announce yield curve control or money printing or more QE, or it's not inflation, or whatever they want. When the market gets it in its mind that it's inflation and it's bad and I don't want to own bonds, it will sell off, yields will go up, and there's little the Fed could do about it. If you want a quick example of that, fourth quarter 2018. Jay Powell gave a press conference on December 19th, 2018, said, look, we're going to reduce the balance sheet by $60 billion a month. It's going to be on automatic pilot. It's going to be about as interesting as watching paint dry. The Dow Jones Industrial Average sold off 600 points during his press conference and tanked from top to bottom 20%. Within 2 weeks of saying that, he came out on January 4th, 2019 and said, no, now the Fed's going to be patient and flexible. All else planning was completely thrown in the trash, and they went the other way. If the bond market sells off, they will do an about face about as fast as they did in the fourth quarter of 18. But it's got to sell off first. It's got to see signs of inflation first. They're not here today, but I'll bet by mid next year you'll see them.
So what does this mean for, well, we know if interest rates rise, that's bad news for bonds because you can lose capital as interest rates rise. What about the stock market?
One of the things that's been powering the stock market higher, and this is all this talk about a blue wave and everything, is that there's tremendous government support for companies and earnings and bailouts, and the airline industry is still alive, and everybody's getting money to spend and buy stuff to keep earnings up. All of that, as long as you have no inflation, that works. And the market, as I call them, the risk markets like stocks, corporate bonds, are happy with that. When you get inflation and the market says you got to start acting on this inflationary impulse, well, how does the Fed or the markets do that? Stop with the spending. Stop with the purchases of bonds. Stop with the purchases of corporate bonds. The risk markets are not going to like that when it comes along because they're dependent on that for earnings and the support of the market. A lot of that money is going into retail trading accounts and all of the day traders, what we call the Robin Hooders and stuff. All of that starts to reverse if we get enough inflation that the bond market gets spooked. James Carville 25 years ago said, I don't want to be a 400 hitter. I want to be the bond market. You could scare everybody. That still applies. It's just that the bond market's been asleep for a quarter century. If it wakes up again because of inflation, then it's going to demand all this stuff stop, all the stimulus stop. If it doesn't, it'll just sell off harder and keep pushing up rates until we get to that point that we stop it. So that's why inflation is so important.
So given this possibility that we enter an inflationary environment, what about hard assets, gold, silver, real estate, commodities? How would that do in this environment?
Well, most of them will do very well. They'll continue to move higher. Gold will do well, and precious metals will do well because they're an alternative to what I'll call fiat currencies. In an inflationary environment, the dollar, the yen, the euro, the British pound, as a group, don't do very well. But something as an alternative to it, like gold and maybe even cryptos, will do much better. Real commodities are continuing to move higher, whether it's copper or aluminum and the like. Real estate is going to be the tricky one here. And the reason I say real estate is the tricky one is there is a shift in thinking. You don't want to necessarily rush into large urban office real estate because there's a movement towards work from home and away from working in the office. There was a recent survey in the Wall Street Journal that 76% of large companies, 76 plan on reducing their office space. There's going to be a glut of that stuff if that is indeed true. Residential real estate, it seems like in prior cycles, it was larger urban areas were the high beta version. So when real estate went up, Manhattan real estate led the way. And then as you got to the suburbs and the exurbs and the rural areas, they went up too, but to a lesser extent. Now it seems like it's almost the opposite. It's exurbs and rural, and that stuff is leading the charge. But as you get closer to Park Avenue in Manhattan, it's not, maybe not going down, but it's not as performing as well. So real estate is going to have that other instance in there that you have to be careful of. But the more traditional hard assets, the old joke that if you could drop it on your toe, it's an investable idea. That kind of stuff should work in a return of inflation, be it commodities or some generic version of real estate or real rate bonds. There are those bonds that are tied to the CPI index, and the CPI index should go up as well too, and that those would actually be superior performers to regular types of bonds.
A final question. We're talking about something with the return of inflation, rising interest rates, maybe even the bond vigilantes returning. Let's talk about something else that could impact the market. Let's just say Biden becomes president and the Democrats take the Senate, so they have legislative power, and they implement a lot of the tax proposals that he is saying that he will do as president. What impact would that have on the market? If the economy is weak, Jim, and we're still dealing with high unemployment, I'm not sure raising taxes would be a good idea.
It's not. It isn't, and it never has been. In the blue sweep scenario that you talked about, you're talking about three things that would happen. One, there would probably be a tax hike. He's all but promised that. And in a blue sweep scenario, they would at least have the control of the House and the Senate to actually make that happen. We could see whether or not it would, but you'd have to assume that we're moving in that direction. Two, one of the big unsung things that Trump has done to be very supportive of the stock market over the last 4 years has been to cut regulations. And by a lot of measures, he's cut regulations more than any other president has cut regulations. Biden has promised to re-regulate. So add more burden and cost to doing business on top of everything else. That might be coming as well too. And three, they promised that the spending packages and the stimulus packages that they would do after January 20th would be in the $2 or $3 trillion range on top of everything else we've already done. That could really push the line for inflation, especially if you start handing people checks and you give them a vaccine. So here's some money and go back to work. We could definitely see some kind of a spurt of inflation. All of that could lead into, I think, problems for the market. Wall Street's the opposite. We want the blue wave. They're cheering on the blue wave because their assumption is there's no such thing as inflation. And so if we could run trillions of multi-trillion dollar deficits, and we can have the government be a third of GDP, something it hasn't done outside of World War II ever, without consequence, we could go full MMT then at that point. And what I mean by full MMT is we just keep borrowing for everything we want to do, and we keep going. The only thing that stops that, and even the MMTers would say this, is inflation. Is if you borrow like crazy and give everybody free college tuition, or you borrow and you give everybody free health care, if you don't get inflation, you can keep borrowing and give them more freebies until you get an adverse outcome. That's inflation, and that's when it stops. So they'll keep pushing the line until we get inflation. And going back to my metaphor again, and that horse rips the post up off the ground and starts running because it's worried about inflation. Only then would we see things start to change, but that hasn't happened yet.
Well, a lot of things to keep our eyes on going forward. Jim, as we close, you do a lot of interesting work. How could our listeners find out more about your newsletter and the things that you put out?
I think the simplest way is to follow me at Bianco Research on Twitter, or Jim Bianco on LinkedIn, or check out our website, biancoresearch.com. There's a link there to request a free trial to take a look at what we do. But if you follow me on Twitter or LinkedIn, mainly Twitter more than LinkedIn, I am posting stuff all the time on what we do up there to kind of give people a feel for the types of things that we're talking about.
Well, you do great work. Jim, as always, it's a pleasure having you on the program. Stay safe